Alright, today's bank is CrossFirst Bankshares Incorporated. They're located in Kansas with a ticker of CFB. It's a fairly average sized bank, at least for publicly traded community banks. It's got about $7.5 billion of assets. And we're going to be looking at the first quarter 10Q. They did just release the second quarter earnings, but haven't put out the 10Q yet. So this 18.6 million is about the same as what the first quarter was. We've also got return on assets of 1%, which is great. 3.2% on net interest margin, which is fantastic. Return on equity 10.59%. So all those things are really good. Basically right in the middle for an average bank. So and I think that the first quarter is going to look similar. So we usually look at the 10Q because it's got all the footnotes and all the MD&A and everything, and then we check the earnings release, which just happened a few days ago, just see is it still in line with what the first quarter was, etc. And it looks like it is. So anyway, over the past year, it's had a really good run up. Look at this. And then, this is similar for most all banks right now. Like the past week or so has just been stellar. Huge gains in banks. So we've all done really well. PE ratio now is a little bit high. We're usually looking for somewhere around 10. And so 12.5 it's a pretty high PE ratio. That's about an 8% earnings yield. For the past little while, we've been seeing banks within the 9 to 11% earnings yield, so 8% earnings yield is pretty low. No dividend here, so keep that in mind. One of the things to note while I'm thinking about it is they do have some preferred shares that they pay dividends on, and they note that I think most of the preferred shares are owned by related parties, so perhaps members of management or something like that. Anyway, if we go to the statistics, we can come over here and see that the price to book is about 1.21. That's a little bit on the high side. We typically see somewhere around 0.8 to 105. So a little bit high price to book ratio, as well as the PE ratio that we saw. So it looks like the price on the bank is pretty expensive based on its earnings and its book value. But it is making good money from this statistic. So almost 1% return on assets. That's what we saw on the second quarter release as well. 1% return on assets. And so that's really good money. It's about average for what most banks are earning. Yep, so now we've got a preliminary idea of what we're looking at. Let's start going down the balance sheet. So we see cash of about 200 million. Looks like securities of about 800 million. So cash is about 3% of the assets and securities about 10% of assets. So both of those are on the low side. While the loans have about 6.2 billion, and that's about 84%, so that's a little bit on the high side. So it's looking like the bank is a little more allocated toward loans than it is to securities and to cash, which would mean more than likely they're earning a pretty good interest income because the loans earn a higher yield than the securities and the cash. Or at least a higher interest income than what most banks are earning. But on the flip side, they might not be as liquid as the average bank, who might have more cash or more securities on the balance sheet. So on the liability side, we prefer to have as much non-interest bearing deposits as we can. We've got about $1 billion here, and that represents about 14%. That's a little bit on the low side. Most banks, or the average bank, we might see somewhere between 20 and 25% of their liabilities being non-interest bearing. So we've got a little bit more interest bearing liabilities than the average bank. But it looks like most of it is in the savings accounts and not a whole lot of debt. So the debt is about 1% of the liabilities. That's a really, really low amount. So it looks like the bank's able to rely on deposits, which is a cheaper source of funding than perhaps the debt is, which is good. So if I were to guess, I think the interest expense would be pretty average because we've got a lower amount of non-interest bearing deposits, but we also have a bigger allocation to interest bearing deposits than to debt, which might give us a lower yield. And the leverage is about the same. It's about average for the average bank, a little over 10 times assets to equity. So we're really looking at an average amount of leverage, just a little more allocation toward loans than to securities and cash, and then a little more allocation to time deposits and savings accounts, which might decrease or make our interest expense about average, given that there's a smaller amount of non-interest bearing deposits. So let's see if that's the case. So we've got interest income, 119 million, and that's about 6.65%. Wow. 6.65% of assets. That's a really large percentage compared to most banks right now. I mean, the average bank is somewhere in the 5%. So these guys, and it's mostly coming from the loans. So about 7% or the loans are yielding about 7%, and that's really, really high for this particular quarter. I mean, the average bank might be somewhere around 5.5 to 6% yield on their loans, but this one's 7%. So, not only do they have a higher yield on their loans, but they also are more allocated toward loans than to the other asset types. So that probably boosts their interest income really good, which is over 6.5% yield on the assets. So that's a really good yield. So then we've got 62 million of interest expense, and it looks like I might have been wrong. So we've got, that is 3.75% yield, which is pretty high, even for this quarter. I mean, we've been seeing some in the 3%, but not that high. And it looks like the interest on the deposits is what's called, so 3.77% yield on the deposits. That's a pretty high amount, so I'd be interested to see why that is. And actually the interest expense on the FHLB advances and other borrowings is pretty cheap. It's only about 1.13%. That's really interesting how cheap that is. Anyway, so all that together puts us at net interest income of about 56 million, and that's about 3%, and that's right in the middle of the average that we would be looking for, average bank right now. So they're earning really good net interest income. They've just got a tremendous yield on their loans, which is giving them good interest income, and then unfortunately the interest expense seems to be a little bit expensive due to the deposits. So maybe we'll find out a little bit more about why that is. But coming down to the non-interest income, we've got 5.5 million, which is about 4%. That's really, really low. We usually see somewhere between 10 and 13%. So 5.5% non-interest income is not that much at all. And I guess they don't have much ancillary services like wealth management, insurance, all that type of stuff. So a little bit less non-interest income than we would see for the average bank. But as far as the non-interest expense goes, it's really, really cheap. So 37.5, that's about 30% of the revenue. So that's a really small amount of non-interest expense. So all that together puts us at about 18 million. And that's a return on assets of about 0.98%. And that's right in the average for what we would like to see for a bank to be earning on its assets. So the bank's making pretty good money. Now if we compare that to the bank's market price, so what is its share price, We've got a market cap of about 880 million. So annualizing this by multiplying it by 4 and dividing by the market cap gets us about an 8.33% earnings yield, which is that's a pretty small earnings yield. Most of the banks in our population, at least before this past week's run-up in market prices for banks, has been somewhere around 9 to 11%. So that's what we've been looking for. And now this bank is yielding about 8.33%. Makes me wonder if the recent run-up has put all of the banks into a lower earnings yield. But either way, we would prefer to be earning a little bit more from our investment. So perhaps it could be the case that all banks are a little bit overpriced now. If the recent run-up in the past week has caused the earnings yield on all the banks to be, in the 8s and 7s. I don't know. I couldn't picture many people wanting to buy a bank for that low of a yield. Anyway, for this bank, it's got fantastic earnings, so that's awesome, but it seems like we've got to pay maybe a little bit more than we would want to for those earnings. And there could be situations where we would say that we would be willing to pay this higher price, but in that case, all of our risks that we're going to talk about and explore shortly, all of them would have to be stellar, for us to be willing to buy a bank more expensive than the average bank that has average risks, right? So anyway, let's keep going and see if we can learn a bit more about the bank and its risks and decide whether paying a higher price is reasonable. But we can see that the name of the bank is CrossFirst Bank. They've got locations in Kansas, Missouri, Oklahoma, Texas, Arizona, Colorado, New Mexico. So a lot of different places throughout the U.S., pretty geographically diverse. As far as the securities go, as do most banks, they have a lot of mortgage-backed securities, but actually not as much as the normal bank does. They only have about 38% of their securities in mortgage-backed securities. And then the largest allocation of their securities is to municipals, which is about 44%, and then the rest to SBA pools. So you could say the mortgage-backed securities are riskless, while the municipals and SBA pools might have some credit risk. But I believe they don't have an allowance on them. Yeah, the company did not record any credit losses. And they also provide a table here, structured a little bit differently than what is presented for most banks, but as is the case for most banks, most of the securities are way out here, older than 10 years, right? So that presents a little bit of risk for interest rate repricing risk and we'll dive into that once we get further along and can compare that to when do the loans reprice, when do the deposits reprice, etc. But they do have a pretty good yield on the securities, it seems. We could see some securities at some banks being, down to 3% or lower. I believe one of the 8Ks said they recently sold about 80 million of their securities to reprice it or to reinvest in higher yielding securities, which is a great idea. We've seen a lot of banks be doing that lately. That must have been last year sometime, but the hard decision for that is it makes a loss on your balance sheet or your income statement, right? Because currently all the securities are sitting, not all of them, but most of them are sitting at an unrealized loss, which isn't captured on the income statement until they're actually sold. But you can see we're sitting here with securities, most of the security portfolio, yielding about 3.5%, and we're stuck in that for 10 years, right? So we don't know what's going to happen in 10 years. interest rates or yields on the same securities could go up to 10, 15, 20%, and we're stuck in 3.5%. We're missing out on that while all the other banks are taking advantage, right? So that's the interest rate repricing risk we enter into. Anyways, loans. All right, so from this we can see that the bank is very much a commercial bank. We got C&I is about 2.2 billion. Commercial real estate, almost maybe 3.3, yeah, over 3.3 billion. So commercial real estate represents about 53% of the loan portfolio, and C&I represents about 34% of the portfolio. Both of those are higher allocations than what we would see for the average bank. So, and on the flip side, the residential mortgage loans are really low allocation. So that could be a lot of why we're seeing higher yields in the income statement. We saw 7%, which is way higher than what we would see for the average bank, and for most of what we've seen so far as we've been analyzing the quarters for all the banks. So maybe allocation to more commercial loans is giving them a higher yield. And on the flip side of that, if we're earning a higher yield, is there a higher credit risk, right? And we can see a little bit of that when we go through these risk ratings. So we're looking at the classified loans here: substandard, doubtful, loss. And if we add all these up together, we will get 125 million in total, and that's about 25% of the loan portfolio. That's really high. We would typically see for most banks somewhere between 1.10 to 1.7% of loans being classified, but this bank has 2% of the loans classified, and that's a high amount. And these classified loans are ones that there's been an identified risk within them that makes it more than likely the loan's not going to be paid back in full, either through like normal payments or through selling the collateral. And not to say that all of the classified loans are going to have to be written off. There's a certain loss given default that's going to be a lot smaller than the balance here. Anyways, for most banks, we would see a reserve that equals at least about the amount of classifieds. So we'll see if that's the case once we learn what the reserve is and how it's allocated. But we can see that most of the classifieds are in the C&I and the CRE, which makes sense. So about 4% of the C&I is classified. That's a really high ratio. I mean, it's normally pretty high, about 2% of the C&I loans being classified, but this bank has 4% of them being classified, so it's basically double that of the average bank. All right, so let's keep going and see what else they can tell us about the credit quality. So here's the aging analysis, 2024. It's kind of blurry, but total past due is 58.5 million, I believe is what this says. And then there is 2.9 greater than 90 days and still accruing. So anyway, 58.5 million of loans is about 0.94%, and that's a really high amount. I mean, we would typically see somewhere between 0.5 and 0.8, but 0.94 is a little on the high side, and so that corroborates a little bit of the classifieds being so large as well. But what's interesting to see, I think, is that most of this is in 30 to 60 days, right? Where the past dues looks like in the non-owner occupied. What we've been seeing for a lot of banks lately is that we're starting to get a lot of past dues in the 30 to 60 days, but those don't necessarily fall into the non-accruals yet, because the non-accruals happen typically after they're past due for 90 days. So when looking at the non-accruals or non-performing loans, the credit quality looks fine, right? But whenever you sort of look at the 30 to 59 past dues as well as the classifieds, you can see that, hey, maybe there's some cracks entering into this, and it hasn't gotten bad enough to be a problem, but might be a problem in the future. And that's sort of what we've been seeing with a lot of banks, where the classifieds seem really high, but all the other metrics seem high, which would be a strange disconnect. So case in point, we've got non-accrual loans here. It looks like 12 million, which is actually really, really low. So there's a really low amount of non-accrual loans, but you can see that there's a lot of past due loans when I get to March 2024. So 12 million greater than 90 days past due, pretty close to the non-accruals. That makes sense. But there's a lot of past dues that are, 42 million that are 30 to 59 days, which haven't fallen into the non-accruals just yet. But I feel like it's still a risk, right? And they're sort of identified in the classifieds. So anyway, so now we can see what the reserve is. It's about 75 million. That's about 1.2% of loans, which is pretty average. We usually see somewhere between 1.10, 1.25% of loans being reserved for. So very average amount. But when compared to the classified loans and the past dues, it seems like that reserve might be a little too small. So the reserve as a percentage of classifieds, we usually see somewhere between 90% to 150%, but this bank has 60% of its classified loans in a reserve, or the ratio of reserve to classified loans is about 60%, so a little on the low side. Same thing for past dues. We typically see reserve divided by past dues of about 200 to 400%, but these guys have 128% of that ratio. So it seems like they've got their reserve a little bit lower than perhaps where it should be, given the amount of past dues and classified loans that they have. So that might enter into our concerns for credit risk, because if they have to increase their allowance for credit losses, their reserve, then that's going to hit the income statement when they increase the provision, right? So that's a risk to our earnings. We've also got some derivatives here. I believe 250 million. Yeah. So 250 million cash flow hedge of the variable rate FHLB borrowings, and also some loans as well. So these are pay fixed, receive floating, which is the way that I prefer to see the derivatives go, especially in this interest rate environment where the yields in the market or on new loans or new debt is higher than what's on in this 10Q currently. So when repricing happens, it's going to be at higher rates. So I would prefer those assets reprice at those higher rates than the liabilities. So that means the pay fixed, receive floating is the favorable position. Plus, banks are naturally liability sensitive over the long term. So just from a risk management perspective, it's, in my opinion, best to be at least a little bit asset sensitive. Anyway, so we'll kind of compare this with our interest repricing risk once we get to that section down in MD and A. We also see the regulatory ratios are fairly low compared to most banks. I mean, their leverage ratio 10%, that's pretty good. But once you get into the risk-adjusted ratios, so all these common equity tier 1, total capital, these are all really low compared to where most banks are. And they're above the regulatory requirements to be well capitalized and everything, but just a little on the lower side compared to where most banks are sitting. And it might be due to having so much commercial loans on their books where those get dinged from a risk perspective, right? So it could be it. Now we can go to the fair value measurements. We usually compare the carrying amount of the assets and liabilities. This is what's presented on the balance sheet. And we compare that to the fair values to see, what is the market price for the bank, for the company, compared to the price of its net assets, and decide is that a fair price, but also from a capital adequacy standpoint, do they have enough fair value of capital in place as compared to other banks. Anyway, so they don't have any held to maturity securities, so no difference in fair value for the securities. For the loans, they have a small difference. It's only $40,000 or so. So that's fantastic. I mean, most banks right now would have a pretty large difference here. But I think it's mostly because this bank its loans on its books are yielding a pretty high amount, which is more in line with where the market yields are currently. So maybe it doesn't have such a decrease in the fair value of its loans. And so then there's a slight change in carrying amount to fair value for the liability side, but not a very large difference as is typical. So because they're at shorter durations, right? So not much of a difference from the amortized cost basis. Anyways, so if we subtract the assets from liabilities of the fair values and subtract out goodwill, we can get kind of a tangible fair value of net assets, which is about a little over 600 million. But the market price of the bank is 880 million. Yeah, 880. And so versus 600 million fair value of its tangible net assets. So that means we'd be paying about 1.4 times the tangible fair value of net assets, which is a really good price. I mean, most banks would be somewhere between 1.5 to 2.5 times that we would pay for it. And so this bank's a little bit cheaper from a net assets perspective. And from a capital adequacy standpoint, so a little over 600 million on the tangible fair value of its net assets, and it's got fair value of assets of about 7.5. So that gives us about an 8.5% percentage of net assets compared to assets. So it's sort of like a common equity ratio, tangible common equity ratio, but everything at fair value. So 8.5% is a really good ratio. It's almost 2 times what we would see for most banks currently. Most banks somewhere between 5 and 7. So it seems like the bank, is from a fair value perspective, is fairly well capitalized. 8.5% common equity ratio at fair value. And then I guess at balance sheet value, it's 9.5%. which is pretty average as well. We would typically see 9 to 10.5%. So this bank has 9.5%. It's a pretty good ratio. So it seems like the bank might be pretty well capitalized despite the regulatory ratios being fairly low. I think that's mostly due to the risk characteristics of its loan portfolio. So here they've got a few more of the metrics that we've already talked about. So return on assets 1%, that's fantastic. Efficiency ratio 60%, that's really low as well. and lower is better for the efficiency ratio. It's basically the expenses divided by revenues with a few nuanced ins and outs. But so that's a really good efficiency ratio as well. I think we normally see something like 60 to 65%. So really good there. And equity to assets, like we were talking about, 9.5%. That's a really good ratio as well. Pretty average. So maybe a high earning, or it's actually all these are really average, which is good. So really average return on assets, average return on equity, average efficiency ratio, and average return or equity to assets. And so they jump right in here to this the yield table, which we always look at. It'd be interesting because we know that the loans are yielding really high. Yeah, 7.19%. Wow, that's an incredible yield for this quarter's financial statements. So we generally do not see a yield that high. But I mean, the trade-off is we did see a lot of past dues and a lot of classified loans. So that could be the risk of having a higher yield, right? And especially so if the loans reprice at even higher yields, and then that interest rate repricing risk turns into credit risk when the customer has a tougher time paying their loan payment with the higher rates, right? So yeah, so fantastic yields on their loans. And I believe they had 84% of their assets in loans. So that's just giving them a really good interest income. On the interest expense side, yeah, this is really expensive for the transaction deposits, over 3.5%. That's really high. I mean, we would normally see something in the twos for that. So yeah, that's really, I'm not sure why their deposits are yielding so much. I guess it's just really competitive for the deposits right now. And then the time deposits up to 5%, which, I mean, that's a little high as well. Not unusual to see, but it's pretty high. But then the FHLB borrowings, 2.43%. That's really low. Almost seems backwards. Like FHLB borrowings should be this 4.47, and savings should be 2.5. But yeah, so all that together gives a 3.86%, and that's pretty expensive for the funding cost for the average bank compared to the average bank. But fortunately, they've got really good yield on the assets, but also a high yield on liabilities. So that puts them at a pretty average net interest margin, a little bit on the high side net interest margin, which is good, but also sort of in the normal range that we see. Let me see what we normally see. Yeah, somewhere between 3 and 3.5 is what we would see for this. So 3.2 is pretty average, but that's really good money for right now. And let's get down to the discussion of capital, liquidity, interest rate risk. All right, so liquidity and capital resources. We do our own calculations for this, but remember we saw that they've got pretty low amount of cash as well as a pretty low amount of securities on their balance sheet. And fortunately, almost none of the securities are pledged. Only about 6% of the securities are pledged. So almost all of them become unencumbered securities, unpledged securities, right? So you've got a couple $100 of cash and $700 of securities, and that puts them at about $1 billion of on-balance sheet liquidity. which is about 14%. It's pretty average. Most banks we would see somewhere between 13 and 18, so they've got about 14% on balance sheet liquidity as a percentage of deposits, that's good. And they've also got the ability to borrow $1.5 billion from the FHLB, Federal Reserve, etc. And this is actually a pretty low amount. 33%. I'm not sure why this is such a low amount for a bank that have $7.5 billion of assets. Most banks can borrow up to 40 to 50% of their assets, something like that. And we would normally see something like 70 to 80% of deposits and the amount of total liquidity, but this bank's only got about 40%. So it's really strange. Like, the total liquidity is about half what we would see for most banks, but they have a good amount of capital, good capital adequacy. They had a lot of on-balance sheet liquidity, so I'm really confused at why they don't have more. And because the thing is, basically all of their loans are pledged, which was $6.2 billion. So why is there not more than $1.5 billion that they're able to borrow if they've pledged $6 billion, right? So it almost leads me to believe that maybe this is incorrect, or maybe I'm misunderstanding or misread what they intended for this. But it seems like they should have a whole lot more off-balance sheet liquidity than they do. Either way, they've got a pretty good, based on the calculations that we've done, they've got a really good amount of on-balance sheet liquidity, about 14% of deposits, but also a good amount of capital, even when converting it to a fair value. It's like 8.5% of assets, which is almost double what we would see for the average bank. And the regulatory ratios are pretty on the low end for the risk-adjusted ones, but for the leverage ratio, it's pretty average. So I feel pretty comfortable about the capital. It's just really weird that they don't have more off-balance sheet liquidity at their disposal. Okay, so let's see if it talks a little bit more about interest rate risk. Yeah. So we can see here that if interest rates go up, their net interest income goes down. So that means they would be a little bit liability sensitive. Yeah, so slightly liability sensitive. I prefer a little bit on the asset sensitive side in the next year, but it doesn't look like this is too bad, right? 1, 3, 4% of net interest income wouldn't be a whole lot of money, so almost pretty close to neutral, right? But we do our own calculations for this as well, and they explain a little bit about it as well, the details for it here too. But as we saw in the footnotes, the securities, most all of them reprice at least 10 years from now, and in our calculation we can see that 92% of them reprice at least 5 years from now. So that's a long time to be stuck in 3.5% yields. So that's a risk. But on the flip side, they've got a lot of their loans repriced within the next year, like 62%. And that's basically double what we would see for the average bank. So they've got a really large amount of loans that will reprice this year into higher yields. And so that's fantastic. And that's might be why they've got such high yields on this quarter's income statement as it is. Maybe their loans reprice a lot quicker than those of most banks. And I can see that that's the case because we jotted it down. I think maybe I didn't note it in this video, but about 75% of their loans are floating rate, either floating rates or they mature within the next year. So we consider those as, variable rates in a way. So 75%, and that's a really high amount because most banks are kind of 50-50 on floating versus fixed rate loans. But these guys have 75% of their loans reprice within the next year. And that's just, or variable or mature in the next year. So that's just fantastic. But then on the deposit side, we see that they had a low amount of non-interest bearing deposits, which was about 14%. So those don't reprice. If there were a lot more non-interest bearing deposits, then we could say that a smaller amount reprices. But in this case, about 83% of their deposits reprice within next year. So those should be ones that are either savings account type things that sort of reprice really quickly, or time deposits that reprice within the next year. It's about 83%. That's a lot. So it's actually about $5.5 billion that reprice within the next year on the liability side. And they don't have a lot of debt, fortunately. But then about $4 billion of loans that reprice within the next year. So that's kind of the liability difference there, liability sensitivity. It's a little bit where, it's the deposits, more of the deposits reprice faster than the loans do, but there's a lot of loans that reprice when compared to most banks that reprice within the next year. So if we were to compare the repricing of this bank to that of other banks, it would be more asset sensitive than other banks. So it's slightly liability sensitive, but not so liability sensitive compared to other banks. So I like the interest rate risk of this bank. If we were to compare it to the average bank, it's less at risk for interest rates to increase and then net interest income to get squeezed as the liabilities reprice faster than the assets do, right? So I feel really good about the interest rate risk of this bank compared to those of other banks. So I think that gets us to the end, and we can sort of summarize everything here now. We saw it's a really, really profitable bank, really good, well-run bank. I think the return on assets was right around 1%, and it was for this more recent quarter as well, the June 2024 quarter. So that's fantastic. Return on equity is good. It's for the past couple quarters they've been making good money, but the market price for the bank also wants us to pay a higher price for those earnings. The earnings yield from the price that we would pay now is about 8.33%, which is really high. And it could be partly due to the big run-up in price that has happened over the past week, and that might not show up quickly enough for us to look at it. But over the past week, there's been a big run-up in price, and it makes it to where now the banks aren't as cheap as they might have been several months ago. So we could have a situation where all banks are a little bit overpriced, or at least priced more expensively than they have been in the recent past. So anyways, so we would be paying a pretty high amount for these earnings. So in order for us to want to buy the bank, we would want the risks of those earnings to be muted, right? But the first thing we saw when we got into the loan credit quality is that perhaps their loan portfolio is has a little bit lower credit quality than what we would see in the average bank, because we saw that they had a lot of past dues, a lot of classified loans. Um, Even though the non-accruals were pretty low and non-performing loans were pretty low, it looks like there's maybe starting to be some cracks in the loan portfolio as the classifieds, and especially the 30 to 59 day past dues are getting some pretty high amounts relative to other banks. But then they had a reserve that was average with the average bank. So I feel like they should probably and will eventually need to increase their reserve a little bit higher, and that'll of course hit the income statement. So that's a risk to our earnings that we're using in our pricing calculations, and is the pricing reasonable? So we've got a risk there that our earnings might go down due to the provision. On the flip side, the capital seemed to be adequate. When we converted everything to fair value, the net asset value compared to the asset value seemed to be even better than the average bank's percentage there. So it seemed like the capital was adequate. The regulatory ratios were a little on the lowest side for the risk adjusted ratios, but I think that has a lot to do with their loan portfolio being much more allocated toward commercial loans than to maybe residential mortgages, for instance. So that's making those ratios be a little lower, but the leverage ratio seemed to be pretty average, about 10% or so. So they also seem to have really good liquidity. The on-balance sheet liquidity, we saw that cash was pretty low. Securities are pretty low, but they didn't have any of their securities pledged. So they have a lot of unsecured or unencumbered securities compared to other banks. So they had a lot of good on-balance sheet liquidity. But as far as off-balance sheet liquidity goes, I feel like either there was misrepresented or misspoken in the financials, or I just misunderstand it. But they didn't have a whole lot of off-balance sheet liquidity, even though they've pledged basically all of their loans, like $6 billion of loans, but they only had like $1.5 billion of off-balance sheet liquidity, like they could borrow from the FHLB or FRB. So I'm not sure why that is, but they had a much lower off-balance sheet liquidity than most banks do for whatever reason. Anyway, I still feel like that they have a good amount of net assets and on-balance sheet liquidity where they're fine, right? So I don't see any differing risks there. From the interest rate repricing risk, they're a little bit liability sensitive, but not as much as other banks are currently. And I prefer the banks to be a little bit more asset sensitive. So I feel like they had nearly 60% of their loans repriced within the next year, which is a really high level compared to where other banks are in that, the asset liability management. So even though they had more deposits that will reprice within the next year than loans, it's not so much of a difference compared to other banks. So as things reprice into the higher market rates, they're not going to get squeezed as much as the other banks do when the liabilities reprice at higher yields than assets do. So I feel like the risk in the interest rate repricing is lower than other banks. So to recap all of that, really profitable bank, but also a higher price on those earnings than what we could buy other banks for. And credit risk might be a little bit too high, where they might need to increase the provision some point in the future, and that will reduce our earnings as well. But they do have good interest rate risk and good good capital. So all that together, I feel like the bank is a little bit more expensive than what we would want to pay for it currently. It does seem like it's a good, well-run, profitable bank, but we would prefer to buy a bank it's yielding a little bit more for our return, and there's a lot more banks out there that are yielding that much with good risks too. So we're going to save our capital for those banks. Anyways, thank you for listening. Definitely do your own analysis, and let me know in the comments what you think, or if there's anything that I missed or am incorrect about, or correct. I'd love to hear what you have to say. So thank you for listening.